In this video, I'm going to show you how to take a simple trading strategy and significantly optimize its returns using Python. The strategy I'm going to be using in this video was created from the analysis we did in the previous video. Now, don't worry if you haven't watched it, I will link it in this video if you'd like to see it. But just a recap for those who haven't seen it, using the pound against the dollar forex pair over the last 5 years, we did some analysis into technical indicators that look like they may be able to help us predict the prices, and these were Bollinger Bands and the MACD line. We then did a long-only backtest, which outperformed the market by around 4%. Now, it's worth saying that although the return was greater than the market by around 4%, it was still a negative return. So the strategy is better than how the market performed, but it's still a negative return, and that's why I want to optimize this further. And I think there's a lot we can do in terms of optimizing this to really increase this return as much as we can. But just to go over where we left off with this TA strat class, this strategy, as part of the backtesting.py Python library. And the way the strategy works is quite simple. So we have our current price, we have the current Bollinger lower band value, the Bollinger upper band value, and then we have our MACD line and a MACD signal line. And what this strategy does right now is if the current price is greater than the lower Bollinger Bands, but in the last 2 hours, because we're dealing with 15-minute interval data, right? So within the last 8 time periods, so that's the last 2 hours, has the current price at all been below the lower Bollinger Bands, right? So what that's going to look like is, at this point here, for example, right, we see a crossover here of the MACD, that's great, but has the lower Bollinger Bands been below, or has the close price rather, been below the lower Bollinger Band in order to validate essentially this signal? And then we do the same for the MACD. So we can say we want the MACD line to have crossed below the signal line within the last 2 hours. Now, there's a lot that we can optimize here. We can optimize the period in which we look back to validate these signals. So we could say we want to look back, say, 4 hours or 8 hours or 16 hours to see whether this signal is valid, right? We don't just have to look at the last 2 hours. We can also optimize our take profit, which currently is just a 1-to-1 risk to reward ratio. So currently the take profit is 1% and the stop loss is again 1%. So that's another thing we can optimize as well. I'm going to start with optimizing these values here, right? The values in which we look back to see whether the signal is a valid entry signal. But actually, just before I do that, it's important that this strategy can also short as well as long, right? Right now we're just buying. Let's make sure this strategy can also short the market to take advantage of when the strategy thinks the price is going to go down. So what I've done here is something very similar. It's just the reverse of this entry criteria here for this long position. So we're saying if the current price is below the upper band, so it's breaking through the upper band. So we have if the current price is greater than the upper Bollinger Bands over the last 2 hours and the current price is breaking through the upper band, which is essentially these two conditions here, and the MACD is less than the signal line, but the MACD before was above, so we're seeing the MACD line cross through the signal line, then we want to open a short position. And I've just done the same in terms of a 1-to-1 risk to reward ratio for now. Obviously, the take profit for a short position is going to be below the current price and the opposite for the stop loss, so that's why we have the reverse here. So what I'm going to do for the optimization, I'm going to create a new class variable. So I'm going to say BB, which is Bollinger Band. We're going to say long look back, and we're going to set this to 8 for now because that is exactly what we have here. And I'm going to do the same for shorting. So we're basically going to have 2 different variables, one for shorting, one for opening long positions. And we're basically going to say for this part here, if the current price at any point in the last n time periods was below the lower Bollinger Bands, that would be our particular condition for this part of the entry criteria. And that will make sense in a second if it's not so clear right now, but hopefully it is. So what I'm going to do is I'm going to insert that here. So we're just going to say, instead of 8, we're going to say self.bb long look back. And then we're going to do the same for the short position. self.bb short look back. And I'm going to do something very similar for the MACD line. So I'm going to create a variable called MACD long look back. I'm going to set this to 8 as well. And then I'm going to create the reverse. Obviously, we want one for short positions as well. And I'm going to input that one there. And then I'm going to take this one and I'm going to input that one here. So essentially what we're doing here is we are parameterizing the strategy so that we can fine-tune and tweak the parameters to increase the rate of return. And that way you can enable your strategy to make the most money possible. Now, there's no guarantee that your optimal parameters are going to work best in the real world, but hopefully this gives you a better understanding of what parameters are going to work best for your strategy. And finally, what I'm going to do is I'm going to have the take profit and the stop loss as tunable parameters as well. So I'm just going to set these as their default for now, just 1%. And I'm going to change where we define the take profit and stop loss here. So this is just going to be 1 plus the take profit. And this is going to be 1 minus the stop loss. And then for shorting, it's going to be the reverse. So we're going to have 1 minus the take profit and then 1 plus the stop loss. Now, after doing this, we're going to define the parameters that we want to optimize and their specific values that we want the backtesting library to try out to see which ones boost the return the most. So to do this, what I've done is I've created this block of code here. So we have BT to optimize. So BT is our strategy that we created. And then we're going to optimize the variables that we just created. So we have our Bollinger Band long look back. So we're setting this from 2 to 64, but we're incrementing it by double each time. Same for the short look back for Bollinger Bands, and same with the MACD as well. And then for take profit, our take profit and stop loss values are quite low, but that's because the interval in which we're trading at is 15-minute interval, so it's a very small interval, so there's likely not going to be that significant price movement. So we've got our take profit and our stop loss pretty low, so it ranges from 0.25% to 5%. And then we have a constraint here, which is basically we want our take profit to be greater than our stop loss so that we can maintain a favorable risk to reward ratio. And then we have our max tries. So we're going to change this as we go, but I'm going to set it to something quite low, as like 20 for now, just so we can get this optimizer working and just see what the results look like. Now this is finished running, we can have a look at our results. So if we look at our return percentage, we can see that this is pretty good. We've got a 125% return versus the buy and hold of minus 4.78%. So this is massively better than we got before. So this is a really promising start for this optimization. Now, return percent is obviously not everything. We have to consider other variables as well. So for example, if we look at the max drawdown, this is 20%. So this means that the strategy, where it performed at its worst, was losing us 20% of our initial capital that we put into this strategy. Now, that is not ideal. We don't want the drawdown to be that significant, even if the return is really high. And also, if we look at our win rate is 38.78%, so it's not too bad. You can actually have a really good strategy with a win rate that is below 50%. Some people think that you need to have a high win rate to have a good strategy. That's not true. It really depends on how big your winning trades are and how small your losing trades are. For example, let's look at our best trade, right? Our best trade generated a 5% return, and our worst trade generated a minus 1.2% return. And that's largely down to the constraint that we set here, which enforced our take profit to be greater than our stop loss to prevent any losses from being too large and being too much greater than our winning trades. So before we move on, let's quickly look at what parameters were actually the best. So we can see that the Bollinger Band long lookback period was 16, so that's the ideal for that based on this particular optimization run. Same for the shorts Bollinger Band. The MACD long look back is 2 and the MACD short look back is 32 periods. And then it selected a 5% take profit and a stop loss of 0.5%. So for this strategy, we have a really favorable risk to reward ratio. In fact, it's actually 1 to 10, right, which is really good. So what we're going to do now is we're actually going to plot how this strategy has performed and just have a look to see if there's anything that we can improve. Now, already we've got a high percentage return, and that's great, but there's ways that we could improve this even further. Now, all you need to do is just run bt.plot. So what it will do is it will open this HTML file, and you can see how well the strategy has performed over time along the close prices. So we see that at this point here, we had a huge jump, right? So the strategy made a lot of money from shorting at this point here. And we had a massive jump from around, we were 15% up or 16% up. And then all of a sudden we were almost 250% up, right? So this was I would even argue, quite a lucky occurrence, right? This is not something that ever occurred throughout the running of this particular strategy. But if we look at other areas, so we see that after this massive jump, it was at 250% almost, and then it actually went down to 225%, or if we have to subtract 100 from that, right? So that's where we get our 125% return at the end. So you could argue that, and in fact, it may be the case. I would have to look into it in more detail, but it may be completely possible that without this kind of lucky jump here, this strategy may have not performed so well. And that's why it's important to look at the output of the strategy like this, so you can see how well it's performed and to see whether there's any things like this that you need to be aware of. But we can also see here the strategy actually made some money at this point here. Now, what I'm noticing from this is that the strategy seems to not do so well in low volatility environments, right? If we look at this point, this area here and this part here, the volatility is not that extreme, whereas here it's a lot more extreme. Here it's also a lot more extreme, and these are the points where it tended to make the most money, right? Same here, it made some money here as well, and it started to actually improve. We can see the equity actually increasing. So there's an argument to be made here that if the strategy only trades in high volatility environments, it should perform better, right? That can at least be a hypothesis. So one thing we can do is we could optimize the strategy to find a parameter that will allow us to open a position if the volatility is above a certain threshold. Now, it's quite convenient because we're already using Bollinger Bands, and Bollinger Bands can help us measure the volatility of the market. So what I'm going to do is I'm going to create another variable, and I'm going to have this variable measure how much greater the upper band is from the lower band, so that we can have an idea of what the volatility looks like. So for example, if we see here with this example, we've got the upper Bollinger Bands and we've got the lower Bollinger Bands. This part here is highly volatile, and we can see how the bands become quite far apart at this point here compared to this area of low volatility. So we can create a variable to measure this difference and enter into trades if we see this difference above a certain threshold. So I'm going to create a variable called current BB dist, and this is going to be equal to the upper Bollinger Bands. So this is going to be a simple percentage difference, right? So our upper Bollinger Band minus the lower Bollinger Band divided by the lower Bollinger Band. And then what I'm going to do is I'm going to create a new variable here. And this is going to be called min BB dist for open. And for now, I'm just going to set this to something like 1%. And what I'm going to do is I'm going to wrap both of these entry criteria into another entry criteria for opening a long position and a short position. So I'm going to say if current BB dist is greater or equal to, and then I'm going to have minimum BB dist for open, then and only then can we enter into some positions. The volatility growth could either be advantageous for a long position or a short position, right? Because volatility goes in both ways. But what's most important is that we have volatility. Otherwise, there's very little room for us to make any money. And now what I can do is I can take this parameter and I can put it into our optimization function here. And then we can optimize this to find the ideal entry criteria for opening positions based on the volatility. So these are the values that I'm going to go with. Now again, we're looking at 15-minute interval data, so we're not expecting huge volatility, but we need to expect at least some volatility, right, in order to open a position. So we have 0.1%, 0.25%, 0.5%, 0.75%, and 1%, right? So we're not looking at huge moves, but we're looking for something that's greater than, close to zero, basically. So let's run this and see if we can beat our 125%. So what's interesting is it actually performed worse. So we have 93.9%, but what's interesting is that when we plot the strategy, we see that it might actually be better quality than the one before. And I'll show you why that could be. We still have this same jump, but after this jump, we actually see the value of the equity increasing, right? So after this jump, we're about 60% up, and then the value of the equity keeps increasing as time goes on, to the point where at the end, we're about, I think it was 94% return. So from this point here, we're actually doing quite a lot better than the previous strategy in terms of the difference in equity after this massive jump and at the end of the strategy. Now, unfortunately, for this period here, before this massive jump, the strategy didn't perform so well. It was hovering around sort of the initial equity value and didn't really go much higher. But we've got to remember, we're only optimizing for 20 different combinations of parameters. If we increase this to, say, 200 or even 500 or 1,000, perhaps we could get much better parameters that generate a much better rate of return throughout the backtest. So why don't we give that a go? Instead of max tries of 20, let's increase that to 200 and let's see what the results are. Now, this may take quite a lot of time, so bear that in mind. So this did take a while to run, but I think it was worth the wait. So we have a return of 321%, almost 322%. So that's a really good return. And we have almost a 50% win rate. So this has worked quite well, just increasing the number of iterations and combinations of different parameters that the backtesting library can test out. Now, as we did before, I'm going to visualize what this looks like, and we can see how well it performed throughout the backtest compared to the other strategies. Now, similar to before, we have really good performance from this jump here to the very end. It went up by almost 100% more from at this point here. But the problem is with this part here, where the equity value, the return just hovers around the initial equity input. So what I would recommend is, if you want to take this strategy further, try and find a way to detect what's happening here and prevent the equity value from just hovering around the input equity throughout the entirety of this period here. There are points where it's not great, so I would recommend trying to find a way to try and optimize this part while still retaining the success of the strategy on this part here. But overall, a 325% return is really good, and it's a really good start for developing a strategy that could potentially be deployed in live trading mode. But obviously, there's so much that you need to do before you can get to that stage. Now, we're just going to look at the optimal parameters that the optimizer selected, because I do want to rerun this strategy, and I want to set a commission. So we set this as 0 just because I wanted to see how much we could boost this return in theory. But obviously, a broker is going to charge you a commission, or they're going to charge a spread. So when it comes to forex, because we're working with forex here, a lot of brokers won't charge a commission, but there'll be a spread there. You can simulate that spread using this commission. So for a lot of forex brokers, the spread is around 0.2%. So I'm just going to set that to 0.2%. So we can see that the return obviously drops quite significantly when we add a commission, but the return is still very good. It's 43.56%, which is a lot better than the buy and hold return. So that's everything for this video. As always, all of the code, all of the data will be included in the GitHub repository, which I'm going to create for this video. So that'll be links in the description below. And if you enjoyed, please like the video, subscribe, and I'll see you in the next one.